Hi, and welcome to another episode of Money Talk. In Money Talk, we have a lot of things to say about how we handle our money, what we do with our money. But you know who else has a lot to say about what our money does or doesn't do, or what we owe or we don't owe? You guessed it, it's the IRS. So the only thing I know that's for certain is death and taxes, and I'm not certain how the IRS figured out that they could get us even in our death. But my guest today is going to talk to us about the things that we need to know about the IRS. It's not as scary as that three-letter word implies. So I have a really special guest, and today we're going to have probably the most difficult thing that I will have to do is pronounce this woman's name. But stay with me, and we'll be right back.
Linda gave me the courage, the confidence to move forward.
And after I was finished with Linda K's training, I was at the next level.
It's Linda K. When you trust that piece of you that says, I got something to give, I have something to say, you know you've got something to do.
Get on your feet, shake your hands in the air. Welcome to the stage, Linda K.
And we are back. And just as I promised, today our special guest is going to talk to us not only about how to decipher what the IRS says, but how to decipher what those really irritating little notices say that scare the hell out of you, that go, you've been written to by the IRS. And at that point, we'll kind of go, our eyes roll into the back of our heads, and we stop thinking logically. We start thinking scarcity. We start thinking about, oh my God, jail time. We start thinking about, stop it. Stop and relax, because right now I'm going to bring to the stage our guest, Folasade. Folasade, hello and welcome. Now, I said the hardest thing I'm going to do today is pronounce your name. So I got the first one, Folasade Ayegbus, correct?
Yes.
Oh my gosh, I can't even believe that. Stars for me. Ding, 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 ding. Okay, Folasade, what does that name mean, and where are you from?
Oh, well, my mom's Black American and my dad's Nigerian. So my name means like brought into wealth, like money.
Yes.
Yes.
Well, no wonder you're a guest on Money Talk, of course. So now, so your dad is Nigerian. So did your mom answer one of those Nigerian letters that says, hi, I'm a prince and I need you to move money? And
No, Linda, she ended up getting in the other way around. She ended up getting in the cab, and that's how they met.
She actually saw him. He wasn't perfect as a false prince,
Yeah.
and in trouble. And all we need to do is get your bank account and move our money into yours, right? We've heard them. We hear about those scams all the time. Tell me something really promising in these scams. Tell me that the IRS now allows that as a tax deduction, as a business expense. So when we get defrauded with that money.
Actually, yes.
What?
Yes. If you were to get scammed, and see, I had did some content about maybe 8 months ago about casualty losses and casualty thefts and thefts regarding businesses and individuals. So if you are an individual that ended up being scammed in your business and your personal life, depending on the circumstances, on whether or not you were reimbursed by the insurance provider and things like that, and whether or not the scam was considered a scam by the government or the police, or FBI.
Right.
Yes.
Oh my gosh! I'm telling you what, Folasade, I'm going to send you somebody that had this happen to them, and we all hear about these things now. I don't know about anything more scarier than a scam or getting a letter from the IRS than a scam, because I was even caught in the middle of something like this, and it sounded so official. It sounded so real. And I'm not a pushover. Let me just tell you that right now. There is nothing about my personality that says I am a pushover, but yet I was in a state of panic. I was ready to send $15,000 for something I never did. And all of a sudden, I'm hearing more and more and more stories. And my particular client was scammed out of $40,000. They don't call up anybody. They're so humiliated. It's such a shameful experience. And I think that the only other shameful experience that we can have is if we're dragged into an audit.
Yep.
And we're told, you held out on us. You owe us money. Okay, shakedown. at the highest level is at the government level, right? From the IRS. How the hell does something like that happen?
Well, an audit can happen from several situations, Linda. You can probably misrepresent it or misreported your income,
Not
understated.
that I never would. Wink,
Yes,
wink.
understated your income, or claimed a credit that you normally don't take. So, like for example, some people have sold a home and never reported it. So, guess what? The IRS is not going to send you a notice.
Oh, no, no money. That is not going to happen. IRS says part of your retirement fund belongs to me.
Yes. And then also, depending on how you file your tax returns, a lot of people, especially business owners, Linda, they're actually claiming 000. So they'll say, "Oh, I paid my contractors 4,500. Oh, my PayPal expenses was 3,000. Oh, my cost of goods sold was 4,000." Just flat numbers that can trigger an audit.
4,000, 3,000, 2,000, as opposed to 2918.17
Yes.
cents. Is that what we're saying? How smooth that is? Because who sits and says, "Oh yeah, I rounded up all of my expenses"? Nobody does. We want to take every deduction we possibly can, don't we?
Yes, you should. Most people don't realize that those roundups, you more than likely understated your expense because you just did it, you guesstimated. That's
Right.
word. So that's one of the main reasons. And then also, let's say if you withdrew money from your retirement account and misclassified it and said it wasn't taxable, or said it qualified for a certain exemption, that may trigger an audit. Let's say, for example, this is your first year having a business and your business having a loss, that can trigger an audit.
Well, what business doesn't have a loss unless you already had your business going to begin with in your first year, right?
Thank you.
So yeah, I'm hearing you. I'm loving that. I'm loving that story. So let's take a few steps back and let's talk about some of these things. Some of them are age related, some of them are business related. So let's talk about when you can withdraw money from, say, an IRA account, a self-directed IRA or a Roth. In a Roth or an IRA, Roth is after tax money already, so you're not paying taxes on that money when you withdraw, correct?
Exactly. Then you still have to meet two requirements. Well, one or the other requirement. So a lot of people get a little creative when they're getting close to their retirement age. They may have had like a 401k of some sort at their job, and then they want to roll that over into a Roth IRA, which is great because you end up saving a lot on taxes and things like that. But you also have to pass the 5-year mark, meaning you have had to have that.
The what mark? Give that to me.
5-year mark.
The 5-year mark. What is that?
Yeah, so the 5-year mark basically says that the year that you rolled over the IRA, the 401k into the IRA, that constitutes year one. You have to wait 5 years in totality before you can withdraw money without paying taxes on it or having the early withdrawal penalty.
Uh-oh. Yeah,
Yes.
you don't want that. Unless you're a certain age when you start putting your in, right?
Yes, unless you are 59 and a half.
So you were thinking about leaving that miserable company anyway, right? So you go, I want to move that into my Roth IRA. I'm 59 years old. I don't have to wait no stinking 5 years. I'm going to wait 6 months, right?
Yes, that works.
That works.
Yes.
Now, if you've had money in there, when do you have to finally start taking it out?
Well, they keep playing with the required the age for distribution. So I think it's now
age is just a number, Folasade.
Yes, I think it's now 73. Last year was 72. Yeah, I think it's 72.
Holy moly.
I know it's for sure 72, but if I'm not mistaken from what I read, I think it went up for 2024 to 73.
Okay. And why is that? Why do you think that IRS is playing with our numbers, our age?
Well, they're playing with it because it's aligned with Social Security. The individuals that are contributing to their Roths, contributing to their 401ks, they also contributed to their Social Security. So what they're trying to do is extend the time in which they have to start paying for Social Security. So now they're making and also pushing back the required minimum distribution age so they can align that with Social Security, because the more money that you have coming to you when you're collecting Social Security, the less Social Security you will end up receiving.
Oh, okay. So they just moved the line back so you can start collecting, but we don't have to start paying you. At least not amount that we thought we would.
Well, they will end up paying you less because you also have that other income that's coming in from your retirement accounts.
Oh, nice. Oh, if it wasn't difficult to try to figure this out. All right, so let's talk about selling something. So let's sell an asset.
Yes.
And you're in New York, are you not?
No, I'm in Maryland.
Maryland, that's right. I'm in California, where we just give a blank check to the Franchise Tax Board and to the IRS and go, so you fill in the blank, right?
Yes.
We have so many taxes. So, but there's this one little piece of the code in the IRS code that makes it a little bit more palatable to sell an asset like our home if we did something. And the thing that's coming to mind right now, Folasade, is the notion of a 1031 exchange. So
Yes.
let's talk about that for a second.
Okay. Well, first of all, before we even go into a 1031 exchange, we actually need to understand exactly what it is.
Okay.
1031 exchange allow you and I or investors to sell a home, okay? And instead of actually paying taxes on that money that you end up receiving at the sale of your home, you end up now having an intermediary come in. They will hold the funds and tell you, well, not hold the funds, but contractually oblige you to hold
They become the third-party escrow company, so you have arm's length from that money. So that money's not coming into your account, so you have to pay boot on it, right?
Exactly. So, so what they'll end up doing is coming in and then basically giving you 45 days to end up finding a property that is similar.
Ladies and gentlemen of the jury, we
Yes.
now gun to our head and pull the trigger. You have 45 days to
Yes.
live.
And yes, if you're unable to
No,
find
it's so stressful. I have represented so many clients in a 1031 exchange. It makes my head spin and hurt. But it is the one tool that's available to us, whether we're an investor or we're a homeowner.
Yes.
Now, as a homeowner, just so we can make this distinction, it isn't available to any homeowner. It's only available to homeowners that did something. It's only available to homeowners that have made an income on that property.
Yeah, I was about to say it's not your primary, or it's not your primary residence as well.
I see. So if it wasn't your primary residence, let's think about this for a second, because this is a tax planning idea. I told you we're going to talk about more than money. We're going to tell you how to keep more of it. That's it. I like this. So if somebody buys a house, they've already had this house for 20, 25 years, say for instance. They buy another house, a cute little beachfront property, and that's where they spend a lot of their time. They typically don't call it their primary residence because they're trying to tell the, I don't know, the lender it's my primary because, and there could be lots of reasons why people do that. You get a better rate if it's your primary resident, if you're going to finance the house. But if you didn't finance it, it's probably in your best interest to call that that new place your primary residence, because now what Folasade just said is that we can now take that capital gains that we make on that primary, what used to be that primary residence, and if you've been in there, oh, I don't know, 5, 10, 15, 20, 25, 30, 35, or you inherit it. Inherited is a different story. We'll get to that in a second. But you've been in that place. Let me just say, you could have probably 5x, 6x, 7x, 8x your property from your initial investment. And guess what? The IRS knows where you live. They know where to send that statement. And they know just exactly how to get you and get under your skin by telling you you owe money. So, Folasade, tell us how we can take that original house that's no longer a primary residence and avoid capital gains. What can we do? Okay,
well, first of all, you need to consider that either secondary home or rental property. It really depends on the income and the financial situation of the individual. But to really reduce your capital gains tax, it really needs to be a rental property.
Yes.
It needs to be a property that you have listed and available for rent. It needs to be rented for at least at a minimum 1 year. So 12 years would be short-term capital gains, which is taxed at a higher rate. 12 months or higher is long-term. So you're able to get a better tax rate in that sense as well.
So, and does it make any difference? And again, I am not expecting that this is tax advice. This is hypothetical. Anybody could be having this conversation with you. And I understand that if they want to have a conversation with you, let's just tell them how to do that right now. Let's put that up on the screen. Hello at accountingwithfolasade.com. Get our phone number. That does look like a Maryland phone number now that I look at it, 202-618-1297. So if you're looking for some tax advice or you're looking for some ways to be able to plan out your estate a little bit better, or you got some questions that you want to get answered, call her, because you're going to find out all kinds of good stuff like we're talking about right now. All right, Folasade, talk us through this next theme of this 1031 exchange. So what we're doing in that instance then is we're taking that property, the capital gain. So if we paid $600 and we now sold it for $2 million, we have a $1.6 million gain, correct?
Yep.
We also have this other thing called exemption, right?
Yep.
How much is an exemption worth?
Okay, well, if you are a single individual, your exemption is worth $250,000. So let's say if you sold your house and your house was worth $500,000, you have equity in your house of $300,000. You will only pay taxes on $50,000. Okay. If you are married and you jointly own the home and you file jointly on your tax return, because that matters, then you guys will qualify for the $500,000 seller home exclusion.
Okay, which means that that's free money. Something is going off in here. Hang on one second. You keep talking. I'm going to go find the source of that thing. All right. Looks like it stopped on its own. But Folasade, what that means then is that $250 for an individual, $500 for a couple, exemption, which means that you get to keep that money on the gain, right?
Well, no, that means that you won't be taxed.
Oh, I see. So you might owe it someplace else, but if you didn't owe anything, hypothetically, you would get all of that money in the sale.
Exactly. You will get all that.
You wouldn't owe any taxes on it, right?
Exactly. Yes.
All right. So now we're getting somewhere. What happens when the individual didn't notify? Doesn't the escrow company have an obligation to tell the IRS, say, hey, she just sold that property, he just sold that property, here's what that was? Because isn't there some kind of a code, like a 593 or something like that, where people have to fill that out and say, hey, I just sold this. This is what I paid for it.
Yeah, so the individual taxpayer wouldn't have to complete the form. The title company or the mortgage, whoever does the loan, the settlement, they will end up reporting a 1099-S to the IRS, basically showing the gross proceeds that you received at settlement. So even if you didn't take home the $250,000, they're going to still report the gross amount of that sale. So if the sell of the house was $500,000, IRS is going to get a notice on Form 1099-S saying, hey, they sold their house for $500,000. Now it's left to us to know what our basis is and include the correct amount on our tax returns.
So what if you don't, and I'm sorry to keep asking these questions about a house, but I actually am selling a house. So these are interesting to me. I never took depreciation on my house. Does the IRS just assume you're an idiot and you didn't do it? Or do they let me take that credit at the time of sale?
Okay, well, it really depends. Well, let's separate this depreciation first for businesses and individuals, because there's totally two different scenarios.
Totally. All right. Yeah. So let's just say from a personal perspective,
you
have a home and you don't take the deduction for depreciation.
Exactly, because you haven't depreciated the property. Now, let's say, for example, you own the home and you rented out the home, or you used the home for your business and took depreciation. Then what happens is we have to recapture the amount that you depreciated over the years. And even
if you never depreciated, whether you rented it out or you lived in it, you're not doing a recapture. So in other words, for our listeners,
hold on.
If you told the IRS, I'm going to depreciate this, maybe maybe I have equipment that I depreciate for my business, but maybe I didn't do that for my house. And you can't depreciate land because dirt is just as old as dirt, and dirt is dirt. So it's just the improvement on your house, right? So when you're taking that depreciation, let's just say it was $1,000 a year, and you have a lifetime, maybe 39 years to depreciate fully, or if you took different accounting practices with accelerated depreciation, we don't care how you did it, you did a depreciation. You're saying that at the end of its life, when we get ready to sell it, I have to pay that back?
You have to pay tax. Yes, that will be considered income.
This
Yes.
just seems wrong, doesn't it?
Yeah, it is wrong. So basically, a lot of individuals don't tell us this, that depreciation is deferred asset. It allows us to delay the tax. It doesn't go away. So what happens is when we depreciate the property, it reduces your taxable income. So you end up paying less taxes.
I see.
Year. So by the end of the lifespan of your property, when you go to sell it, you've accumulated that depreciation and you've gotten a tax benefit. It wasn't included in your taxable income. So once you sell it, especially if it's a property that was used for business purposes, you have to recapture that depreciation. And what's even messed up, Linda, is that even if you didn't take the depreciation those years, you still have to recapture it. Tax law states that you have to take allowed or allowable depreciation. You have to recapture it.
So whether I did it or I didn't do it, I gotta pay it back.
Exactly.
That blows me. Now, is there some benefit because I'm now in a lower tax bracket, or it doesn't make any difference? Is capital gains just capital gains?
Well, it is a benefit throughout the years, especially if you were considered a mom and pop, where your income, your collective income in your household was $125,000 or less. You were able to take the tax write-offs up to $25,000 for your rental properties and things like that. But if you exceeded that income limit, all you did was accumulate those losses. But the beautiful part about it is, if your taxes are properly done correctly, you are able to offset those accumulated losses throughout the year from the sale of the home.
Okay. All right. Let's move on to something else, because now I'm really totally depressed. I've got to hire an accountant before I do this. What kind of problems do you solve, Folasade? When people come to you, you sound very, very knowledgeable about the IRS code. And I got to tell you, that's impressive all into itself, because that thing's over 1 million pages long, right?
Yes.
So, and any part that we don't like, we just go, oh, let's just insert another set of instructions in there. And so we can reference it and keep cross-referencing so that people will finally fall asleep while they're trying to cross-reference each and every piece of the IRS code, right? It's confusing. It's designed to be confusing. How do you make sense out of this?
Well, you have to stay constantly learning. I'm going to be honest with you. I ended up almost burning out with this COVID. All of this COVID stuff, it was just so many laws, things thrown at you. So basically, you just have to stay on top of your expertise, your reading, and just constantly mastering taxes, especially with all of the massive changes that we're falling under every year. And then also I provide my clients with a peace of mind. Being an IRS enrolled agent, I've represented clients all over the country. I've done OICs, I've done abatements, I've reduced clients' taxes of the millions of dollars. So when people tend to come work with me, I give them that peace of mind. And then also I end up giving them kind of like the best bang for their buck, in the sense of, I not only just prepare the taxes, but I line that up in conjunction with helping them, and I hate to say this word, build generational wealth, because what I'm finding is, especially in my community, Linda, a lot of them are not having retirement accounts. So the first step is, hey, I don't see one. Your job have one. I need you on one by the time you come back next year to get your taxes done. Once they're able to do that, Linda, then I'm like, okay, well, they can be a little disciplined in doing that. Okay, then the next step, do your child have a 529 plan? Do you have this? Do you have that? And then I started just using the tax return as my gateway to really open up the doors for people to start saving and investing and getting their feet wet with, growing their finances.
Typically, where do people make their first investment? So let's just say you've got a young employee, they're in their first or second job. They didn't pay attention to the benefits, maybe a matching contribution from their employer, or they didn't know anything about a cafeteria plan for their medical or anything like that. And now they come to you, and because they just started a family. So they're already pushing the envelope of, making that dollar stretch further than they thought it could. What do you advise them to do so that they can keep more of their money?
Well, the first thing, Lynn, and I hate to say this because people don't realize how important this is. We first need a household budget. We really don't know.
Budget, what's that?
Yes, we have to, because we need to know what's coming in, what's going out, and what's left over, so we can know what to do with what's left over and whether or not that's even the correct amount that what's supposed to be left over. So with the household budget, then we're able to see, through their W-2s and their pay stubs, right? I'm able to see what do they have, or do their job offer a child dependent program? Are they on it? Is the job paying the health insurance? Are they getting it from the marketplace? Do they have a Roth? Or do they have a traditional IRA outside of their job? I just start picking their brain, but it really just starts with the first step, getting in a retirement account. I don't care if it's on your job or at your neighboring bank, at least get started with that. Then if they have children.
It's so funny because, when you think, hey, I'm 30 years old, you think 60 is way the hell down the road. And I'm going to tell you right now, it kind of sneaks up on you, kind of like that tortoise in the hare. Did the tortoise really sneak up, or was the hare asleep? Right?
It's been a tough year, Linda, when some of my clients, they do not have retirement and they're still working. It is painful when they say, I'm tired and I really can't work, but I have no choice but to work. It's been a painful year this year, seeing people don't have any investments or no retirement. So guys, suck it up. I know it may seem like you have far away. You don't. Get started now. So once I realized, Linda, that they have like a retirement account, they got that set up or so, then we start to now do the 529 plans, or the COG plan for their children, put their children in private schools or preparing for college and things like that. And then now with this new 529 ruling that they did on Internal Revenue Code 529, they ended up allowing us to roll over the 529s of our beneficiaries into Roths. So even if your child decides.
That's so awesome. So in other words, the parents that are saving for their kids' school under a 529 plan, which is now a sheltered plan under the IRS code, completely legal, so that you can direct that money to their education. Some kids go, the hell with that. I'm going to apprentice school. I'm not going to some hoity-toity, Ivy League. I'm never going to get in there. Why even bother? Mom, just give me the money. Dad, just give me the money. You can't do that. But what she's saying is that you can now direct that back into your own account, into a Roth account, into a Roth now after tax money. So if the 529 was pre-taxable, is it taxable now to be able to go into the Roth IRA?
Well, no, it still follows the same rules from the Roth. Once they reach a certain age, they can pull it out.
Nice.
Yeah, so they're good in that sense. But also one thing I want to add, they did add a new inclusion. They are allowing you guys to go to trade school using your 529 plan now.
Did you hear that? The kids don't want to go to college. Send them to school.
Exactly.
Make them learn a skill so they can go feed themselves. That's right.
So they can go to trade school now.
That's awesome, because I know a lot of kids that just don't want to. They're not motivated to go into school. And I don't know if you have college-bound kids, but the last time I paid part of the tuition, I almost passed out. When I went to school, which was back when the dinosaurs ruled the earth, I went to San Diego State, and at that time, carrying 16 units was only $200 a semester. It's $200,000 to get out of school now for a 4-year education. That is just insane. I don't know how parents and even kids are saddling themselves up with these kinds of student loans and the other things that are not even forgivable. So get that 529 underway and send them off to trade school if they don't want to go to college.
Yep.
It's the best thing you could do for your children, honestly, besides giving them financial education, helping them understand how to make a budget, helping them understand what a balance sheet looks like, what it looks like to do a P&L. A P&L, they're like, what? A what? A profit and loss. And even if they do something just really as simple as just putting it into a spreadsheet and learning how to account for what they spent in a given month, they'll be far, far more ahead of the game than somebody coming out of school going, I don't even know how to balance a check. I don't even know how to open a checking account. Okay. How can you let your kids do that? You cannot. I'm going to rail on this one because that is so important to me. My child had a checking account, a savings account, and she understood that there were 3 parts to $1 when she had her first job at 12 years old. From paying herself to paying tzedakah or having charity to being able to take what's left and spend on what she wants. Because if she wanted something, she had to earn it, to find it.
I love that.
So financial independence starts with education.
Yes, it does.
So what kinds of things make you laugh when you get a phone call from a client? Because I used to be a systems engineer.
Okay.
And again, back when the dinosaurs ruled the earth, they would call and go, this doesn't work. And this is when we had floppy disks, not USB drives and the things that we have today. And I would say, well, why doesn't it work? When they'd stick it into the machine and well, I just put it into the typewriter, typed across it and labeled it. And I'm like, I'd put it on the phone and go, oh boy, we've got another. And I would laugh at it because, some of the mistakes that people make are so laughable, right? They're so basic. You tell them, don't do this. What's the first thing they do? They go and do it, right? So what makes you laugh when you get a client and a new client that says, oh my God, Folasade, help me, Jesus.
Okay, so what makes me laugh then is when they call and say, oh, Folasade, I want you to do my taxes. I have a business, but I didn't keep up with any of my paperwork for my business. I don't know what my expenses are. And I don't feel like going back and calculating them. And
so then you tell them, come in, make an appointment because I do have a crystal ball that we have right? I mean, what do you say to them? How are you supposed to advise them if they can't take care of themselves? How can you take care of them?
Exactly. And that's where the challenge come from, is because they don't even realize that they've put money out that could have gotten a benefit for. So I have to thoroughly explain.
What does that mean?
So basically, for every $1 that you guys invest into your business, the IRS will reduce your taxable income dollar for dollar. So if your business made $1,000 and you invested, because like we said, most businesses that start up just are operating at loss, you invested $1,500, but you only made $1,000. That means your business have a $500 loss. That $500 reduces your W-2 income. Let's say if you have entrance income, it reduces that dollar for dollar. So let's say if your W-2 was $100,000, then now you will only be paying taxes on $99,500 rather than the whole $100,000.
Only, Folasade, get me more money. I want more money. Come on now.
Yes. So they're literally leaving. So I have to explain it. Well, your refund will possibly be about $3,000 if you were to go back and calculate, or you will probably owe less than $2,000 if you go back. I have to convince them that it's beneficial for them to accumulate.
Go back and look at the pain they left behind in the shoebox.
Yes. And then I said, also, you don't want us to guess on anything, because if you were to get audited, then you have to spend more money backing up an audit. And then if the IRS agent just basically says that you're not equipped to run a business, they can prevent you from operating a business in the future.
So, Folasade, you are an IRS approved agent. Tell me what that is.
Yeah, so I'm an IRS enrolled agent. So we're
enrolled agent. Okay, so that means that you can do stuff that the IRS will look at and go, her stuff's better than your stuff, right?
Yes.
Okay,
yes.
Excellent.
And they treat us a little bit better as far as I'm concerned. Like when we call, they work with us because we're directly licensed through them. We had to take a 3-part examination to pass to give us become an enrolled agent. Okay,
that's good. Does that also mean, because it's IRS, it's government, you can go through any state, or are you restricted to one state?
Yes, all over we can represent in every state, every 51 states, and then any country as well. So if you're in Pakistan and you're having issues with IRS, I can represent you.
So if you're out of country, you're a U.S. citizen, and you're out of country, you're in country someplace else, and the IRS sends you that nasty little form that says, oh, hello, Linda Kay, would you please come see us? We have missed you so much. Don't panic. Call Folasade.
Yes.
Call her. I can put her number up again so you can see it. Because she will help you, and she will help you make sense and help you stop sniveling or crying in your beer. Because that means if you can't ignore the IRS.
No.
Okay, it's just not going to happen. All right, so let's talk the difference between an employee of a corporation getting a W-2
Mhm.
and a self-employed or self-directed 1099 entrepreneur, right?
Yes.
So our expenses are a little different and they're a little bit more allowable. I think less so if you're a W-2, unless you have a little cottage industry, like a little, I don't know, an internet business, or you coach people on the side, or you do so, teach piano, or underwater basket weaving, whatever that. If you're pulling some coin in, please do yourself a favor and show the IRS, show your state that you're not only making a little bit of money at it, but you have some expenses against it as well. Why are people so reluctant to be able to tell the truth?
Because they didn't do the work throughout the year, Linda. That's why. It's not that they don't want to tell the truth. It's the
They're
fact
not
that
trying to be dishonest then.
Yeah,
They're trying to get out of being accountable, which is your thing.
Exactly. And they're trying to get out of doing their accounting. It's 9 out of 10 clients refuse to do the basic accounting. They don't have a budget. They don't know how much the mortgage was, the rent was, what they paid throughout the year. They have no idea of what's going on with their finances, literally.
No wonder their favorite song is "There's Too Much Month at the End of the Money," right?
Yes. And so that's kind of
They're
where
out of money. They're trying to figure out how the hell am I going to make this work?
exactly.
When they don't even know how much do they need.
And then, you know what was the bad part about it, Linda? Those same habits roll right into when they start those businesses. So what happens is when they have those businesses,
now that's bad.
yeah,
That's
and
really
with that 1099, yes, the IRS trusts you to pay your taxes after the fact, but the IRS is also trusting you to claim the correct amount of your expenses. And people don't realize, Linda, that
that's a problem, don't you think?
Yeah, it is.
It's a problem because here's the thing. As an entrepreneur, and I've had my own business for 20 something years, right? And maybe even longer than that. But at least 24 years, at least this century, right? I have been out on my own. And I have worked and consulted with other companies that have paid me, and they always they always send me a 1099. That 1099 that you receive has already been reported to the IRS, so it's in your best interest, my friends, to go tell the IRS, yeah, as a matter of fact, I did, but I didn't. I made all this money, but I didn't keep any of it. Look at all my expenses against this, right?
It goes even further than just the IRS. If you guys do not claim the income, especially depending on your income throughout the years, right? You're ended up messing up yourself when it comes to retirement. I ended up attending a conference in New Jersey a few years back. And a lot of the hairstylists, they're independent contractors.
Right.
A lot of them admittedly said they never claimed the full income because their tax person or whatever told them, oh, you'll owe taxes.
Yeah.
Guess what?
Right.
Guess what, Linda? Now they're at that age where they're supposed to be getting Social Security. Social Security say you do not have any quarters because they always reported a lower income or a loss. So they never contributed to Social Security being self-employed. And so I know right now we're on edge in terms of who's receiving Social Security or will we be able to receive it. But if you guys were in the baby boomer age range, you're supposed to have already accumulated quarters. But a lot of the self-employed 1099ers did not, Linda, because they wasn't reporting the correct income. So they were never taxed for self-employment tax to pay their Social Security throughout the years.
So I hired a housekeeper years ago and nanny, and she was with us. And the most important thing to her, even coming in from a developing country, was pay my Social Security.
Yes.
Why? Because that meant everything to her. Today, when she's retired, she's now a U.S. citizen, but she's also retired and she's collecting Social Security. How many quarters do we need to contribute to our Social Security in order to be able to draw on it?
I'm not even sure. And because I don't specialize in just older, look at the benefits, but I was just on the site. I don't know if it's 20.
I can't remember. And some people will actually know it. And if you do, throw it into the chat or respond if y'all are sitting out there, just taking in this good information. But it's in our best interest. Now, where it hurts you.
It's 40, Linda. It's
40.
I
was going to say it was 32, but of course it was probably 32 when I was able to start collecting a little bit years ago. And so I could say that, probably it probably increased, and the more time has occurred, more likely that minimum has gone up over the years. Because I think back in the day it was 32. So it's 40 quarters, which is what, 10 years?
Yeah.
40 quarters, 4 quarters a year, 10 years, right? You got to be employed 10 years reporting. All right. That's a simple thing. If you're self-employed, pay it pay it ahead. Now, where it hurts you as an entrepreneur, and let's talk about that for just a second, is you make all this money and you report that you made all this money, but you tell the IRS, I didn't keep any of it because I spent it all on developing my business. Where it hurts us is when we need to go get a loan.
Yes.
Oh, let me just tell you, I didn't even think I could qualify for a loan because I'm in this, I might have told the IRS I made all this and didn't make all that or keep all that. But where it hurts is when you really need to use your income and leverage your sophistication as an entrepreneur and experience and expertise by being able to qualify for a loan.
Yes, but not only loans, Linda, apartments too. Let's say if you needed a rent or office space.
Of course, I didn't even think of that. Oh my goodness.
Yeah. This is they don't
any
want
ideas, any thoughts on that? Because I could tell you how painful that is. Let me just express that for a moment. I bought a condo last year. I didn't think I could qualify for one because I don't have a consistent income. I've been traditionally commercial real estate. And yes, I have a number that comes in annually, but I don't have a monthly number that comes in. And so when a lender is looking at you, they're looking at your capability of being able to repay a loan. What is the probability of you being able to pay this loan back? And so they look at your income and your expenses. What is that? Income minus expense? That sure sounds like a budget to me.
Yes,
it sure sounds like it sure has the earmarks of a P&L to me. So yes, your balance sheet, your P&L, your budget. All of a sudden, I'm like, well, would you take my word for it, or would you look at every one of my bank statements? Oh yeah, they're looking at every one of your bank statements. They're looking at everything. And you get to be scrutinized in a way that you didn't think was even possible. And not only that, at the end of the day, you get to pay more for the money that you're borrowing, even though I probably am far more reliable and a lower risk than somebody that could get fired from their job only because they have a monthly income and I don't. So it is really in your best interest. What advice can you give to our entrepreneurs before we wrap this up?
Yeah, so in situations like this is why it's always best that you guys tax plan and work with your own accountant. Like getting advice from me and Linda and stuff on social is great, but you have to contact us after the fact. Here's why. Depending on your situation, the amount of revenue, your goals, your business structure, things like that. Let's say if you told them you wanted to buy a house and your LLC is making $100,000. We may want to convert your LLC because you're within the income that normally would benefit from having an S Corp. We will end up converting your business over to an S Corp, put yourself on W-2, pay yourself that consistent income that you need via W-2. And then at that point, you will then go and apply for your loan after the fact. I will end up saying maybe wait 6 months to a year once you file that first year's tax return with that W-2 inclusive of the business. But that's one way for entrepreneurs to, one, have the revenue that they need to qualify for loans, properties, assets, and things like that. And secondly, it allows you to reduce your self-employment taxes from the business by converting over to an S Corp. So I would just say, if your goal is to buy a house, buy investment properties, separate yourself from your business, and you make net at least $60,000, you want to convert over to an S Corp, because for entrepreneur, that is the way that you can now get your loans approved. If you need hard money lending, you're trying to do investment properties or rehab flips, you need that W-2 income to make it easier for you to get funding.
Wow, that is such great stuff. And then years ago, I was with Tony Robbins did a business mastery, and the first thing we did was put me into an S corp all those years ago. Now I'm feeling like I'm a smart little cookie.
Yes, you are. Yes. And then you know what? And a lot of people don't realize that the S corp even go further. It's a mechanism for you also to keep more money within your how to say your household, your family, and your business.
Yeah.
Here's why. With the moment you convert over to S corp, guys, you're not able to take the normal business use of your home. So let's say, for example, I have my home right here, and I have this room. Because I'm an S corp, I cannot just easily deduct this space. However, there's a beautiful thing called an accountable plan that will allow you as the shareholder and employee to take a portion of your home expenses, your mileage, your cell phone, your travel, your meals, and everything by having an accountable plan that you get reimbursed consistently. And guess what? You're able to, your business will reimburse you for what you paid, and your business get to write it off.
Well, you heard it here. Get smart, call Folasade. Folasade, thank you so much for joining us today. I so appreciate the knowledge and smart women that just really know how to handle that dollar. Thank you again for joining us. And thank you all for joining us today. Join us next week when we have more information to share with you about how you can stretch that dollar and how to keep more of them. See you soon. Do you like to talk about money? If you do and you'd like to be a guest, contact me at lindak360.com.